Stock markets in Europe are trading a little lower this morning, with the UK's FTSE 100 index currently down around about 13 points, while the Euro Stoxx 50 index is off around about 7 points. The DAX in Germany is trading flat. US stock futures are also lower. The Dow is down around about 20 points, while the S&P contract is off around about 2.5 points. Now, in the currency space, of course, the dollar continues to show good character. It's up against its rivals. The euro is also trading higher, and that's on the back of improving fundamentals. Yesterday we had a very strong Eurozone composite PMI survey. Going on to the commodity space, gold is trading up about $4, and other base metals are also trading a little higher. Oil prices are somewhat weaker, but nothing to be worried about too much, mostly flat. And when it comes to peripheral bond yields, Spanish, Italian and Portuguese are a little wider across the board, but again, relatively calm. German and UK bonds are trading a little lower, but the yields on the Bund and the gilt are still at elevated levels, in line and very consistent with the rising 10-year US Treasury yield, which was recently up around about 2.9%. Good morning, I'm Ishaq Siddiqi and welcome to your Daily Market Bite. It's Friday, the best day of the week, my favourite day, and of course I'm pretty sure it's your favourite day as well. So I'm going to try and make it as quick as possible with this quick financial news wrap up of what's going on, what's shaking the market. So let's have a quick recap of the session overnight. We had a decent gain on Wall Street, despite the fact that we actually had a 3-hour outage on the Nasdaq index. That caused a lot of grief in the market, or raised a lot of concerns about electronic trading. Now, it's an outage for a stock index isn't new news. We recently saw earlier this year the outage of the NYSE Euronext in Europe, which rattled the market with lots of traders making some losses, given the fact that they couldn't get out of their positions before the market opened. At the same time, we've also had a number of issues with electronic trading this week, with Goldman Sachs reporting a 17-minute outage. So again, the big question now for investors, and not only for investors but for everybody in the world, is the use of electronic trading versus human error. Electronic trading error usually entails bigger losses than human error. So investors are looking at the story quite closely. Nasdaq last year suffered from a bit of a reputational hit after the delay in pricing for the Facebook IPO, if you remember that, and that threw a lot of light into electronic trading and some of the downfalls and the pitfalls of that. But nonetheless, the US market showed good character. They rose, and that was on the improving tone coming out from US economic indicators. Jobless claims were better than expected. Now onto the Asian session, we've had a rebound across all major indices, particularly Japan. Asia has sold off rapidly over the course of the week, and that's on the concerns that we're going to see some sort of tapering on board in September. The Fed minutes out earlier this week did not take away from the fact that tapering is still on board as early as September. And when it comes to the Asian market, Indonesia and India were particularly hurt. The rupee in India still suffered, but other emerging market currencies are trading a little higher this morning, along with the stock indices. So that's provided us a better footing into the European session this morning. So earlier this morning, before the European market opened, we had German GDP for the second quarter. It was confirmed at an expansion rate of 0.7% for the period. A very encouraging number, suggests that Germany is now technically out of the woods. It's unlikely to fall back into a recession. It is the powerhouse of the Eurozone. It's the engine, and investors are very encouraged by the news that Germany is now up from its knees, and it's started to show stronger economic growth. It's on a sustainable path of recovery. And this is all music to the ears of Angela Merkel, the Chancellor in Germany, who will be up for election in September. And that's also very consistent with the data that we've seen out of Germany recently, the ZEW survey, the IFO, and also the Eurozone, the wider Eurozone surveys. Yesterday's flash composite PMIs out from the Eurozone, and also the Eurozone GDP figure, which came out last week, again instill a lot of that confidence that the Eurozone is turning a page, and we're seeing this relative calm period in the peripheral debt story, so no flare-ups on that side. Really see investors feeling quite optimistic about the fate of the Eurozone, more so than they previously have been since the debt crisis kicked off a couple of years back, around about 2010 to 2011. Now going on to what we're looking forward to for the rest of the session, we of course have UK GDP for the second quarter. It's the second estimate after the first estimate. The first estimate confirmed at 0.6%. And that's attributed to near enough every facet of the UK economy picking up steam, from construction to housing to manufacturing, industrial, retail sales. The good weather in the summer has also helped enthuse a lot of the UK public to go out there and spend more money, go to the high street, buy more clothes, buy more food. So it's been very good news out of the UK, and we're going to, for the second quarter, we're going to see today's printing at 0.6 again. We may get some upward revisions, which will really be welcome news for the UK market. Sterling should rise on the back of that. We should also see gilts react poorly to that news. When it comes to the FTSE, probably a very neutral reaction. FTSE, we've got to remember, is more of a global index as opposed to a UK index. 70% of revenues from the FTSE 100 are generated outside of the UK, so not the best thing to look at when you're monitoring UK economic data. But nonetheless, good news should come out from the UK in the next hour, and it's only a reminder of some of the strong economic improving fundamentals out of the UK economy. More importantly, I think the big thing that the market will now be looking at is the Bank of England's latest forward guidance measure and what the Bank of England has to say about monetary policies. We have to remember that the Bank of England have put in thresholds for unemployment and for inflation, and investors are somewhat concerned that if we do see a rapid escalation of UK GDP and it grows faster than the Bank of England are expecting, then the Bank of England have little choice but to tighten monetary policy, so hiking rates, and that could derail the economic recovery. So there are some things that we must consider going forward with UK GDP, but for now, in the short term, pretty strong news. Other than that, there are some indicators out of the US to watch out for. New home sales should be consistent with the recovery that we're seeing in the housing market. We also have Eurozone consumer confidence data later on. Corporate news is still on the ground, so really the focus is on data. Of course, we also have the Jackson Hole Symposium in Wyoming in the US. Ben Bernanke is not speaking, but there are the Fed members, and investors will be watching very closely to that, to see what sort of new information they can learn from Fed speak about tapering, because we all know that's on everybody's lips. Anyway, that's all for your daily market bite. Sorry, actually wasn't as fast and as quick as I wanted it to be, but next time I'll try making it shorter for you guys. Thank you. Just watching and have a good weekend.